Okay, let's unpack something fascinating today, especially if you're looking for income from your investments. It's this question: can you actually aim for like an 8% yield after taxes using ETFs? Exchange traded funds. That's a serious goal, right, for income
It
investors.
really is. High target.
Yeah. So today we are diving deep into an analysis that specifically looked at this. It explored how you might build an optimized ETF portfolio, really designed to target that, potentially achievable 8% yield after taxes.
Hmm.
So our mission here is to really get inside this research, understand their approach, see which specific ETFs and strategy they landed on, and pull out the key insights. What did the source actually say about trying to hit that 8% after tax number?
Exactly. And the core idea of this analysis, it's dated May 31st, 2025, for context, was precisely that. Exploring if 8% yield after taxes is, well, feasible using certain high-yield ETFs.
Hmm.
The key phrase, as the analysis makes clear right away, is after tax.
Right, because that's the number that actually matters, what ends up in your pocket. So how did the research even begin? What kind of sources did they look at?
Well, they started pretty broadly, it seems, looking at, publicly available info on high-yield ETFs. They did web searches, pulling from financial sites, Kiplinger, Forbes, U.S. News, Morningstar, places like that.
Okay, the usual suspects.
Yeah. And interestingly, they also look at what financial experts were saying on X. They specifically mentioned accounts like at Income Investor and at Devoted Dividend. So probably looking for current takes, recommendations maybe.
Ah, interesting. So a mix of established sources and like real-time commentary. Once they had that initial pile of info, how did they filter it? How did they narrow down the candidates?
Well, based on their goal, the filtering had two main parts. First, obviously, high pre-tax yields. They look for funds distributing above 6%, really focusing on anything already near or even over 8% before taxes.
Okay, step one, find the big yielders.
Right. Step two, and this was critical because the target was after tax. The analysis prioritized ETFs, where the income distributions might be treated more favorably under tax rules.
Ah, okay, so it's not just the yield number. It's also about how that income potentially gets taxed. That makes sense for an after-tax goal. So based on that filtering, which specific ETFs popped up? Which ones did the analysis highlight?
They flagged several that fit the bill, noting their approximate pre-tax yields and general strategies. The list included JEPI.
JPMorgan Equity Premium Income.
That's the one. Mentioned around 8% pre-tax yield, uses covered calls on S&P 500 stocks. Then JEPQ, similar idea, but NASDAQ 100. Higher yield, though, 11-12% pre-tax.
Wow.
Also CANG, that's the Dividend Aristocrats one with covered calls, 9.35% pre-tax. HYBI, the NEOS Enhanced Income Credit Select,
Uh,
that had an 8.74% distribution rate mentioned from October 2024 data, I think. Mixing high-yield bonds with an options overlay.
Bonds plus options. Interesting.
Yeah. Then KBWI, that's REITs, 9.95% pre-tax. QILD, another NASDAQ covered call fund, about 11%. CTYI, NEOS S&P 500, high income, high yield there too, 12% pre-tax using options. And GPIQ, Goldman Sachs, NASDAQ 100 premium income, also around 11% pre-tax, covered calls again.
That is quite a list. And some really, really high pre-tax yields in there. You mentioned covered calls, options overlays. How did the analysis explain how those strategies actually, generate the income? What's the simple version?
Right. So the analysis points out that a lot of these ETFs get a chunk of their income from selling options, mostly covered calls. The basic idea is the fund owns the stocks, as in the S&P 500.
Okay.
Then it sells the right for someone else to buy those stocks at a certain price later on. And for selling that right, that option, the fund gets paid a premium.
Ah, the premium.
Exactly. And that premium income is what gets distributed to the ETF shareholders. So it's not just dividend, it's this active strategy of selling options contracts. HYBI, as we said, kind of mixes income from high-yield bonds and options.
Got it. So they're actively generating cash flow by selling these options. Okay, let's circle back to the really crucial part. The goal is after-tax yield.
Precisely. And the analysis really hammers this point. Understanding the tax treatment of the income from these funds is absolutely fundamental if you're aiming for a specific after-tax result.
Okay. And, this is where we need to be crystal clear for you, the listener. While this analysis talks about strategies and potential tax implications in general terms,
Hmm.
the actual after-tax yield you would get, that depends entirely on your personal situation, your
Hmm.
income, your tax bracket, other investments, all of it.
Absolutely. It's completely individualized. Tax rules are complicated. They apply differently to everyone. What might be the outcome for one investor could be quite different for you.
So while we're unpacking the research here, we really can't and won't get into the specific tax calculations or how these things might affect your bottom line. The analysis itself actually says this very strongly for personalized advice, for figuring out the actual after-tax numbers for you.
You need to talk to a pro.
Exactly. A qualified financial advisor or, a tax lawyer, someone who can look at your whole picture.
That's a non-negotiable, really. Understanding the mechanics from the source is step one. Figuring out the personal application.
Yeah.
That needs tailored professional advice. It's vital.
Couldn't agree more. Okay, so putting the personal tax calculation aside for a moment, because that's homework for you and your advisor, the analysis didn't just list ETFs. It actually suggested a specific portfolio mix, a model allocation to try and hit that 8% after-tax goal. What did they recommend?
Right. So based on their analysis of the candidates, they proposed a specific blend, a balanced allocation using 3 of those ETFs we listed. The suggested mix was 40% in JTI.
40% JPI.
Okay, then 30% in KNG.
30 KNG.
And the final 30% in HYBI.
Interesting. 40 JPI, 30 KNG, 30 HYBI. What was the thinking behind that specific combination? Why those 3 in those proportions?
Well, the analysis suggests this mix is aiming for diversification. You get equity exposure, mainly S&P 500 type exposure from JPI and KNG, and then you get fixed income diversification from HYBI.
Okay, stocks and bonds.
Right. And the idea is to combine their high pre-tax yields with the potential for how their income streams are treated tax-wise, especially that options income. The source suggests this combination is likely to meet the 8% after-tax target for, well, many investors. But again,
big caveat.
Huge caveat. It stresses it really depends on your individual tax situation. The analysis also throws in JEPQ as maybe an alternative, perhaps for JEPI or KNG, if someone wanted potentially higher growth in yield but was okay with more volatility. So it connects back to that bigger list.
Right. So it's a strategic blend for income and diversification, leveraging those specific fund strategies. But like any investment, especially aiming for high yields, there have got to be risks, right? What downsides or limitations did the analysis mention?
Oh, yeah, definitely. The analysis includes some important warnings. They point out several risks. Market volatility is a big one, especially for the equity ETFs like JPI, KNG, JPQ. Stock markets go up and down, sometimes a lot.
Sure.
For bond ETFs like HYBI, there's credit risk. The risk that the companies issuing the bonds might not be able to pay them back.
Default risk.
Exactly. And a really key point, which they noted citing other analyses like from Morningstar, is about those option strategies. While they generate income,
there's a trade-off.
there can be, and cap your upside. If the market goes on a huge tear, like a massive rally, the fund might not capture all of those gains because of the options they sold.
Ah, okay. So you might miss some of the big upward swings.
Potentially, yeah. That's the structure. And finally, they emphasize that yields, those distribution rates, they aren't guaranteed. They can change. They mentioned HYBI's rate had fluctuated, for instance.
Those are definitely critical points to keep in mind. And it really brings us back to that core advice from the analysis itself. Always, always talk to financial and tax professionals for advice that fits your specific life and goals.
Absolutely critical.
Yep.
Understand the strategy, yes, but make sure it fits you. That needs expert, personalized guidance.
Okay, so let's recap what we've unpacked from this research analysis. It basically lays out a case that hitting an 8% yield after taxes might be possible for some investors.
Potentially.
Using a specific combination of these high-yield ETFs, JEPI, KNG, HYBI, and relying on their income strategies and how that income is structured.
Yeah, it provides a really interesting look at how fund structure and investment strategy could potentially influence your actual take-home return, after taxes are considered.
And it's a big but we've hit a few times, and the analysis hits it too, that after-tax number. It is completely personal.
Totally.
To know how any of this stuff impacts your taxes, your bottom line, you absolutely have to get professional advice tailored specifically to you.
The research gives you a potential roadmap, identifies some tools maybe, but applying it, that requires understanding your own situation, probably with expert help.
So, thinking about all this, what does it mean for you listening right now? Well, here's maybe a final thought to chew on, something that came up in the analysis. We talked about how those option strategies are designed for income, right? But they can limit your gains when the market really surges.
That potential trade-off, yeah.
So it raises this interesting question, especially if you're focused on income. How do you weigh that? The value of getting potentially higher, maybe more consistent income now, versus the possibility of missing out on some really significant growth later if the market takes off. It's kind of inherent in some of these income strategies. Something to think about as you look at what approach makes sense for your own goals.